Good evening, students. Revised the PGBP chapter because today we are going to start with that. Yes, good evening, Kaushiki. I hope all of you have revised the PGBP chapter because I'm going to give you the questions and I am not going to revise with you. You are going to give me the answers and based on that, we are going to solve that, right? Okay. So I hope you are ready for today's session. But before that, there were certain pending decisions that we had to cover because we had covered a few decisions in the last class and few of them are still pending. So that's what we are going to do first and then we'll get on to the PGBP part. Okay. So what was the last decision that we covered was the Ahmedabad Urban Development Authority case. Okay. Now the next is particularly with respect to the TDS provision. Next case is with respect to the TDS provision. So what is the TDS on commission income? What is the TDS rate on commission income? Okay, Kaushiki, no problem. अभी ठीक है? Okay. Yes, what is the TDS rate on commission income? Yeah. Commission income, students. What is the section? At least do not tell me the rate if you're not able to remember. What is the section in which TDS is deducted? It is 194. 194 what? 194 H. Yes, Kaushiki. Yes, Janvi, correct. 5%. No, Kaushiki, it's not 10%. Yes, good evening, Chitala. Yes, it's 5% under 194 H, right? So now, what is this case about? Let me first explain you the modality of the agents of the airlines. So, you try to book your air flight tickets through the Make My Trip, through Yatra, right? Now, how these agencies work basically. So let's try and understand first that, and then you will be able to understand this particular case. So there is this base fare of the airline association which exists under the aviation industry. So the base fare of the tickets is set by the IATA. I'll call this as the IATA. Now, the base fare is set by this IATA. And discretion is given to the airlines to sell the tickets at lower than the base fare, but it cannot go it cannot go higher than the base fare. So the airlines have the discretion to lower down their prices compared to the base fare, but it cannot go higher than the base fare. The base fare acts as a cap to the air ticket prices. Are we getting that? Now the air carriers, whatever the prices they would set, let's say for example, we are looking at SpiceJet, they would provide the fare list to the Director General of Civil Aviation. Now these prices with the airlines will set, it may be lower than the base fare set by the ITA. Now what happens is, the ITA would provide the blank tickets to the travel agents, which are acting on behalf of the airlines. So these blank tickets are provided to the agents which are acting on behalf of the airlines. Now the arrangement between the airlines and the agent is such that they have an agreement in place. That agreement is called as Passenger Sales Agency Agreement. So the agreement between agents and airline is called the Passenger Sales Agreement. Passenger Sales Agency Agreement. Now, this agreement will have the terms and conditions under which the travel agents are required to carry out the sale of the flight tickets and the commission they would be entitled to. So, the blank tickets are sold by the ITA to the agent But the agreement is between the agent and the airline company. Now, the percentage of the commission which an agent is entitled to get, that is also fixed percentage by the ITA, which is called the standard commission, which is based on the base fare. So, a percentage which is a standard commission is set by the ITA, which is dependent on the base fare. So, there would be a, let's say, standard commission. Let's say 7% of the base fare. This is set by ITA. Okay. Now, as I said, the base fare is decided by the ITA. But the airline can sell the tickets at the lower than the base fare. Now, the fare which is set by the airline, the airfare which is set by the airline is called the net fare. So, this is set by ITA and this is set by airline. Now, this could be, as I said, is the lower, can be lower than the base fare. It cannot be higher than the base fare. Now, agent can also sell the ticket at some other price only. The agent can sell the ticket at some another price only. It may not sell the ticket at net fare. It may not sell the ticket at the base fare. Base fare is of course higher. Now, if you look at the prices on Yatra, on Make My Trip, on Goa Vivo, all of them are very different. And if you go to Indigo or SpiceJet airline website, that price will be entirely different. Right? Now, the net fare which is set by the airline. Now, the agents may charge the actual fare, which could be much lower than the airline fare, or could be higher than the net fare. Alright. So, the net fare is charged by the airline. The base fare is decided by the IT. Now, airlines would not have any control over the actual fare at which the travel agents would sell the tickets. Now, if the agent is selling the ticket at higher than the net fare, that differential amount between the actual price charged by the agent and the net fare would be retained by the agent as is again supplementary commission. So, one commission he is getting is the standard commission, which is dependent on the base fare. And secondly, the agent may sell the ticket of the airline at higher than the net fare, and the differential amount will be the commission of the agent again. So, the actual fare charged by agent may be different than the net fare, and therefore the agent may also earn some supplementary commission. So let's take an example of this. Let's say, for example, my base fare is 1 lakh. Net fare is, let's say, rupees 60K. Actual fare charged by the agent, let's say, is rupees 80K. Now, my standard commission will be 7% of the 1 lakh, which is, let's say, rupees 7K. And my supplementary commission would be what? 20K, which is 80 minus 60K. Right? Now, the problem which arises is that on the base fare, the TDS was always deducted under 194H. So, sorry, on the standard commission paid to the agent, this is always subject to the TDS under 194H. But on the supplementary commission, the additional amount that the travel agents charge over and above the net fare, on this supplementary commission, there is no TDS which is deducted by the airline companies. So therefore, the AO treated the airline company as assessee in default. Now the question before, the Supreme Court in Singapore Airlines Limited was that whether on this supplementary commission 194H would be applicable. So the question before the Supreme Court in Singapore Airlines case was whether 194H applicable on supplementary commission. That was the question. So what did the Supreme Court observe in this case? Supreme Court observed that the 194H does not distinguish between the direct and indirect payments. So 194H does not distinguish between direct and indirect payments. So TDS would be attracted equivalently on the indirect payment also. TDS would be attracted even on the indirect payment also. Also, the Supreme Court linked 194H with section 182 of the Contract Act. 182 of the Contract Act. Ma'am, you took us to CPT. Right? I took you to the CPT exams. What is 182 of the Contract Act? Ma'am, we do not even remember section 40 of the Income Tax Act. How will we remember 182 of Indian Contract Act? Right? So, that was done long back by us. But okay, let me take you back to CPT. Contract Act 182 is the principal agency relationship. So if the relationship between the two parties, which is evidently of the principal and agent, as also governed by the agreement, then it falls, the income which is there will fall under the commission and 194H will be attracted. So the contract between airline and agency demonstrates principal agency relationship. Principal agency relationship. And therefore, it would fall in the definition of commission under section 194H. So the Supreme Court noted that the tickets remain the property of the airline. The title of the tickets was never transferred. It was always with the airline company. What the agents do is they sell the tickets on behalf of the airline company. So any ticket which is sold by the agent on behalf of the airline company requires their express prior authorization. And that's why they have entered into the passenger sales agency agreement, which also indicates that any act done by these agents in procuring the customers was done on behalf of the airlines and not independent. So the contract is of the agency. And once it's an agency contract, whatever commission one draws at any stage of the transaction will be governed under the commission income. The fact that the travel agent had the discretion to set the actual price over and above the net fare will not affect the relationship between the two parties. So even the supplementary income which is earned by the agent is actually an effect of the principal agency relationship. Also, they looked at the PSA agreement, which sets out that any payments collected by the agent pursuant to the sale of the air ticket were made in the capacity of agency. And these amounts have to be transferred to the airline company. So all the monies which are received by the agent were held in the fiduciary capacity as the property of the air carrier. And in the billing and settlement, the supplementary commission was separately shown. And therefore, the TDS needs to be deducted on the same. Are we clear? So therefore, even if the agents had the discretion in setting actual fare over the net fare, but that shall not alter the relationship of principal and agent. This was governed by the PSA agreement. Okay. The agents acted on behalf of the airline company and held the amounts in fiduciary capacity. Therefore, even on supplementary commission, (194H) is attractive. Okay, 194H is attractive. Now the AO had also levied the interest under section 2011A and the penalty under section 271C. So in that front, the Supreme Court noted that if this particular amount of supplementary commission was already included in the income by the agent and the due taxes had been discharged, then the assessee cannot be considered as assessee in default. Proviso to section 2011A, which says that if the recipient has already considered it income and paid the taxes and filed the return of income, then the payer may not be considered as assessee in default. Okay? But the revenue can of course charge the interest for the period between the date of default and till the date when the recipient actually paid the tax on that particular income. Right? All of us know that. What about the penalty under section 271C? With respect to the penalty also, the Supreme Court stated that there were contradictory views by different high courts with regard to the applicability of 194H on supplementary commission. And therefore, there was a reasonable cause for the airlines to not deduct the TDS. And therefore, penalty will not be attractive. So you can write down here. Penalty contradictory High Court rulings on applicability of 194H on supplementary permission. Okay. And secondly, assessee not to be treated as assessee in default if recipient has included the income and paid the taxes. However, interest can be charged from date of default till date of payment of tax by recipient. Okay, fine. Any questions, any doubts? No problem, Geeta. Good evening. Okay. Now it is visible. Fine. Okay. Next case is in relation to the, again, interest under 220 subsection 2A, which is what? Interest for the delay in payment of the TDS, right? Or delay in payment of the taxes. What is the interest amount? What is the interest rate which is charged under section 220 for the late payment? Yes, if you pay the taxes late, what is the amount of interest, or sorry, the rate of interest which is charged? No, Geeta, it's not 18%. Yes, Kaushiki. Yes, Janvi, correct. It's 1% per month and not 1.5% per month. Okay. So the interest which is charged for the late payment of the taxes is charged under section 220, which is 1% for every month or part of the month. Now, this was again a Supreme Court ruling. The issue was very simple. So there was the pending dispute under the MAP. What is MAP? Pending dispute under the MAP proceedings. What is MAP? Anyone? Don't give me full form, okay? Give me the meaning. What is MAP? Yes, students, what is MAP? Yes, anyone? What is MAP? Full form I'll only give you. Mutual Agreement Procedure. What is that? Mutual Agreement Procedure is the agreement between the two countries with regard to the settlement of the transfer pricing dispute or the treaty related dispute of the taxpayer. So both the countries agree on solving the dispute of the taxpayer in relation to the treaty issue or the transfer pricing issue. This is an alternate dispute resolution mechanism. No, Kaushiki, it's not a DTAA. DTAA is different. MAP is the dispute resolution. Like we have the appeal mechanism, This is one of the dispute resolution mechanism whereby both the countries' competent authorities come together to resolve the dispute. Okay. So the assessee had gone into the MAP proceeding to resolve the dispute, and since the dispute was pending for the resolution under MAP, the assessee requested that the interest on demand notice. So the demand notice was already issued to the assessee. So interest on that particular demand notice, on the demand which is not paid, should be waived off because the dispute was pending under the MAP. So what happens is generally the AO will issue the notice, AO will issue the notice and the assessment will start. AO will then pass the assessment order. As usual, he would not listen to the assessee's contention. And finally, what he would do is he would issue the notice of demand under section 156. Now, on notice of demand which is issued, what will happen is the 30-day period will be provided to clear that demand. In case the assessee will not clear that demand, then 1% interest is charged on that particular demand, right? Now, section 220, subsection 2A provides the power to the commissioner or the principal commissioner for reduction or waiver of the interest payable under 220 subsection 2. So section 220 subsection 2 provides for interest at the rate of 1% per month on the demand. On the demand, right? After, if the tax is not paid within 30 days from service of notice under section 156. Section 220 subsection 2A provides the power to the PCCIT or PCIT or CIT to waive or reduce the interest provided that the assessee has the genuine, or provided the amount has caused the genuine hardship to the assessee. Provided there is genuine hardship to the assessee, or the default was due to the circumstances beyond the control of assessee. Default was due to circumstances beyond the control of assessee. Okay, and the assessee has cooperated, and the assessee has cooperated in any inquiry relating to the assessment, or in any inquiry relating to assessment or recovery proceedings. Right? Now, what do you think? Whether in this case, since the dispute was pending for the MAP resolution, whether in this case the interest can be waived by the principal commissioner? Yes. What do you think? It's a genuine cause? Yes. Is it a genuine cause? So what did the Supreme Court say? Kaushiki, okay, you believe it's a genuine cause? Let's see what Supreme Court has to say. So the commissioner can reduce the interest payable on the ground of genuine hardship. But here it was observed that the assessee was a part of a global MNC, which had billions of sales and billions of operating profit. This was the important factor which was considered, that whether there is a genuine hardship on the assessee or not. So it was observed that it has the billions of operating profit. Also, it was observed that the profitability, when the court looked at the profitability of the assessee, it noted that the assessee is paying the interest only for million rupees, only for lakhs of rupees. So where it has like the billions of profit in front of that, compared to its profitability, the interest under 220 subsection 2 was few lakh of rupees. So it had the profit of 6 billion and the interest amount was 0.004 billion, which was minuscule. So it was concluded by the commissioner that there was no genuine hardship. So the Supreme Court observed that merely raising the dispute before the map or merely raising the dispute under the map cannot be a ground not to levy the interest or waive the interest under 220. Otherwise, each and every assessee will raise a dispute and then will contend that since the litigation was bona fide, no interest is leviable. And Supreme Court said that levy of interest under 220 is mandatory. Okay. So it was not counted as the genuine hardship. So Supreme Court said that raising of dispute before any authority cannot be ground for waiver of interest. Interest under section 220 subsection 2 is mandatory. Fine. Okay. Okay. Let's move on to the next case then. Next case is with respect to the powers of the tribunal. Next case is with respect to the powers of the tribunal. Now, this is very interesting case. Let's try and understand. So, we can appeal the CITA's order before the ITAT. Or for that matter, there are direct orders also which cannot be appealed before the CITA, but which can be directly appealed before the ITAT, like DRP's order, right? The draft orders which are passed, right? Or the trust registration orders which are there if there is rejection and all of that. There are many orders which you can directly appeal to the CIT, right? To the ITAT. Now, ITAT is the final fact-finding authority. ITAT is the final fact-finding authority. Now, ITAT has the power to rectify its order if there is any mistake apparent from a record. If there is any mistake apparent from record, then the ITAT has the power to rectify its order. Right? ITAT can rectify the order. Now, the question here is, we can first write it over here. ITAT can rectify its order if there is mistake apparent from record. If there is mistake apparent from record. Now the problem here which arose is, in this case of Supreme Court, in the case of Reliance Telecom Limited, Reliance Telecom Limited, here the question before the Supreme Court was that can the ITAT recall and rehear the entire order? Can ITAT recall and rehear the entire order? Can the ITAT recall and rehear the entire order? So section 254 empowers the ITAT to pass the order after hearing both the parties. And 254(2) provides that the ITAT may rectify the order with a view to rectify any mistake apparent from the record. Right? This is section 254 subsection 2. Now, can 254(2) be said to be also including the power to recall and rehear the order? So what had happened in this case? In this case, the tribunal had passed the order in the favor of the department. And against that order, the assessee filed the miscellaneous application. What is miscellaneous application? Any idea? What is a miscellaneous application? Yes. What is a miscellaneous application? So miscellaneous application is usually either to file the cross objection. So if you remember, under the tribunal, what happens is one party files the appeal. The other party gets the notice. Let's say, for example, if assessee is filing the appeal, the department will get the notice that the appeal has been filed by the assessee, and department has to file the cross objection. So for that cross objection, miscellaneous application is filed. Or if the order passed by the ITAT has some error, then the miscellaneous application can be filed. Or let's say the ex parte order is passed, if there was non-appearance of any counsel, then also the miscellaneous application can be filed. So the assessee found the error in the tribunal order because the assessee noted that the agreement, one of the agreement was not considered in arriving at the conclusion by the ITAT. Also, the ITAT had misread the High Court decision. Third, the error found was that the ITAT had ignored the decision of the coordinate benches. And since there were conflicting decisions of the coordinate benches, the larger bench should have been constituted, or a special bench should have been constituted. What is a special bench? In case there is difference of opinion amongst the benches in the ITAT itself, then a special bench is constituted to clarify the position. So there were contradictory position of the coordinate benches, and that was also not considered, and larger bench was not formed. The Delhi High Court's ratio was not considered, and agreement was missed out while arriving at the conclusion. So the assessee filed a miscellaneous application stating that there are inadvertent errors which needs to be modified or rectified. So the application was filed to the tribunal seeking correction of the mistakes. Simultaneously, the assessee also filed an appeal before the High Court against the tribunal order. Now, the ITAT realized its mistake and recalled its original order, and immediately the assessee withdrew the appeal from the High Court also, because the ITAT recalled the order, the assessee withdrew the appeal from High Court. Now, against this order passed by the tribunal, allowing the miscellaneous application and recalling its original order, the department preferred the writ petition. Why did the department did not go for appeal? The department did not go for appeal before the High Court and it filed the writ petition. Kaushiki, rectification under 154 is the rectification of the AO order, not of the tribunal order. The tribunal order rectification is in 254. Why the department filed the writ petition against the tribunal's allowance of miscellaneous application and withdrawal of the order? And why did not the department go for appeal? Why it did go for the writ mechanism? Yes, anybody? Any answer? Yes. These are all practical concerns. Okay, so you should be knowing. Yes. Because the ITAT has not yet passed the new order. ITAT just allowed the miscellaneous application and withdrew the original order. The department can go for appeal only when the order is passed by the ITAT. The appeal can be filed only against the order of the ITAT. Now the original order is also withdrawn. New order is not yet passed. So unless there is a final order, the appeal cannot be gone to the High Court. So therefore, the only option which remains is the writ petition. That's why the department filed the writ petition and not the appeal. No, not because it's a final fact-finding authority, because there was no final order yet passed. Now the matter traveled to the Supreme Court, and what did the Supreme Court say? The Supreme Court said that the order passed by the tribunal, recalling its earlier order, was beyond the scope and the ambit of powers under 254. So that means the tribunal does not have the power of recalling. So recalling the order was beyond the scope of section 254, subsection 2. The tribunal, in fact, had to reheard the entire appeal. And then a detailed order was, so the tribunal first, when it passed the order, it had passed a detailed order holding in the favor of department. So it can only rectify a mistake which is apparent from the record. If the tribunal order was erroneous in a manner that it had not considered the judgment of High Court, not considered the judgment of the coordinate benches, then the only remedy available to the assessee was to appeal before the High Court. It cannot file a miscellaneous application because this is not a mistake apparent from the record. So therefore, the recalling the order was beyond the scope of 254 subsection 2. Are we clear about this? So the tribunal's power under 254(2) is limited to the rectification of mistake apparent from record. 254(2), which is there, is not a freedom to recall the order by changing the view which the tribunal had adopted earlier. Are we clear? Yes or no? Are we clear about this? Yes? The tribunal can only recall the order if there is a mistake apparent from record. Okay? Yes or no? Yes? Okay. The next decision that we are going to cover is with respect to, again, The revenue versus capital expenditure is with respect to the revenue versus capital expenditure. Now, what is that? So, in this particular case, now this you are going to answer me. The assessee which was there was in the business of leasing. The assessee was in leasing business. Okay. The assessee was in leasing business. It obtained the loan in foreign currency. Obtained the loan in foreign currency, which was to be utilized by the assessee for financing the procurement of capital equipment by an Indian entity on hire purchase or lease basis. So it had borrowed this fund for basically giving it to the Indian company to procure the capital equipment on hire purchase or lease basis. The loan was utilized. The loan was utilized for procurement of capital equipment, by the existing Indian enterprise Indian entity. The loan was utilized for financing of procurement of capital equipment by Indian entity on hire purchase or lease basis. Okay. Now, while repaying the loan, there was difference in the exchange rate, and therefore the assessee had to pay a higher amount, resulting in forex loss. So, on loan repayment, assessee incurred forex loss. Now, whether this will be the capital expenditure or the revenue expenditure. Yes. Whether this will be the capital expenditure or the revenue expenditure. Yes, Geeta, I will explain again the earlier decision. So basically, the assessee was in the leasing business. The assessee borrowed the funds from outside India for financing the Indian entity, because assessee was into the business of finance, was in the business of leasing or the hire purchase. It borrowed the funds from outside India so that it can finance the Indian entity with whom it had entered into a lease agreement to enable the Indian entity to obtain the plant and machinery on lease from the assessee. And for such financing, the assessee had obtained loan in foreign currency. So the assessee, since it was in the business of leasing, it borrowed these funds and utilized it for the Indian company so that the Indian company can buy the equipment on leasing from this particular entity, from the assessee basically. So whether this will be the foreign exchange loss on the repayment of loan is a capital or revenue expenditure. Yes, Kaushiki, correct. Yes, Janvi, correct. Yes. Revenue or capex? Yes, Geeta, correct. So all of you are in sync that this is a revenue expenditure. And yes, Supreme Court also held in a similar manner. It was held that this particular expenditure which was incurred. So the activity of the assessee was financing the existing Indian enterprises for procurement of the equipments, plant and machinery on lease and hire basis. And the transaction of the loan which the assessee borrowed from the non-resident was necessary for carrying on the business of financing. It was not for buying the equipment for assessee. It was not for creation of an asset of the assessee. The assessee was therefore justified in claiming this as revenue expenditure. The loan was wholly and exclusively used for the purpose of business of financing for the Indian entity, which in turn had to acquire the plant and machinery. Are we clear? So this was in the nature of the business of the assessee itself, and therefore this would be allowed. Okay. So you can write down. So Supreme Court in Wipro Finance Limited allowed the forex loss as revenue expense, as this was incurred only and exclusively for business of the assessee. Right? This was only and exclusively for the business of the assessee. As this was necessary for carrying on, the loan was borrowed for financing the Indian entity, the Indian entities, which was necessary for carrying on the business of the assessee, which was necessary for carrying on business of assessee. Right? It was not for creation. The loan was not for creation. Loan was not for creation of asset of the assessee. Loan was not for the creation of the asset of the assessee. Are we clear? Okay. Any doubt? So this loss, the forex loss, would be allowable under section 7. Now, one more question before the Supreme Court was, now this claim, which the loss claim which was there, was raised by the assessee first time before the tribunal. The assessee raised this particular claim of deduction first time before the tribunal. So another question before the Supreme Court was, can the tribunal entertain a fresh claim for the first time in exercise of its power under section 254? Can the tribunal entertain fresh claim in exercise of its powers under section 254? Yes. Can the tribunal claim sorry, can the tribunal entertain the fresh claim? Yes, Janvi, if the assessee was in the hotel industry, then the answer would not have remained the same because that was not would have been in the course of the business of the assessee, because then the assessee may have uh, incurred that expenditure or borrowed the loan for purpose of installing the equipment, which would have resulted in creation of the asset for that hotel, and therefore that would have been capitalized under 43A. Clear, Janvi? Yes. Can the tribunal entertain the fresh claim? Yes or no? Yes, Janvi, it can. So the tribunal can entertain the fresh claim. If you remember, there is a judgment of Goetz which restricts the fresh claim by the assessing authority. So the assessing officer cannot entertain a fresh claim other than by way of filing the revised return of income. But the appellate authorities like CITA, ITAT can entertain the fresh claim. So, yes, the tribunal can entertain. The restriction on fresh claim is before the AO. The restriction on the fresh claim is before the AO. The assessee cannot make fresh claim before the AO other than by filing a revised ITR. This was Goetz India ruling, right? And in this case, the Supreme Court clarified that yes, the assessee can raise the fresh claim before the ITA. Are we clear? Yes. Yes. Are we clear? Geeta, in the earlier judgment, the ruling was on that whether ITAT can rectify, or sorry, ITAT can recall the order. So Supreme Court in Reliance Telecom held that the ITAT cannot recall the order. It can only recall if there is a mistake apparent from record. 254(2) allows the ITAT to rectify the mistake apparent from record. Mistake apparent from record means a glaring mistake. It cannot recall the entire order and rehear the matter. Are we clear? So recalling the order is beyond the scope of 254(2). Clear, Geeta? Yes. Okay. Let's move on to the next case then. The next case is in relation to the transfer pricing dispute. Now, this is a very, very important case. SAP Labs India. SAP Labs India Supreme Court. Now, what was the issue before the Supreme Court here? Can the High Court examine the correctness of the determination of ALP? Examine the correctness of determination of ALP if the tribunal determines the ALP. If the tribunal has determined the ALP. Now, all of you know that tribunal is the final fact-finding authority. And on the decision of the fact, one cannot appeal before the High Court. The appeal can be made to High Court only if there is substantial question of law. So when we go for the appeal before the High Court has to formulate the substantial question of law. If it's a question of fact, the matter is final with the IT. Now the question before the Supreme Court was whether the determination of the arm's length price is a question of fact, and if yes, the tribunal, what it has decided, the ALP, it has determined the ALP, the matter cannot travel to High Court. And if it is a question of law, then only the High Court can decide the ALP, decide and determine the correctness of ALP. What is ALP? The arm's length pricing, which is the pricing between the two independent enterprises. Now, if you know about the transfer pricing provision, the arm's length price is determined based on the 5 methods that we have. By identifying the comparable entities, right? First, you find out the comparable entities to your entity, right? In order to decide what are their profit margins, what are their arm's length prices. Only when you find out the comparable companies, only then you can, apply the methods of transfer pricing, right? Now, determining the comparables or selecting the comparable companies, and then deciding or selecting the method of transfer pricing is a very, very subjective exercise. According to me, these 5 companies will be comparable to a manufacturing entity. But the AO may say, no, these are not comparable because their turnover is less, because they have losses or whatever. I may select cup method as the most appropriate method, but the AO may say the transaction net margin method is the most appropriate method. So it's a very subjective exercise, isn't it? So what do you think? It's a question of fact or is it a question of law? My question to you. Janvi cannot be made before the court because the High Court has to formulate the substantial question of law. So fresh claim may not be made before the High Court. Of course, a question may be added before the High Court in terms of the question of law, but a fact cannot be placed before the High Court for claiming an expenditure because the ITAT will decide as a final fact-finding authority. Yes, whether the ALP is a substantial question of fact or a question of law. Geeta, you think it's a question of fact, and Kaushiki thinks it will be a question of law. Okay. Yes, what others think? Kaushiki, you also now think it's a question of fact. Okay. Okay, let's see what Supreme Court says in this case. So the Supreme Court said that the powers of the High Court are with respect to consider the substantial question of law. Now, while determining the ALP, the provisions of Chapter 10 are to be applied, which is from Section 92 to Section 92F and all the rules which are prescribed thereunder. So, any determination of ALP under Chapter 10 has to be in accordance with these provisions of the Act. And if the determination of ALP is not in accordance with these provisions of the Act or these rules, it can be considered as perverse and it may be considered as a substantial question of law, as the perversity itself can be said to be a substantial question of law. So what does it say? That the determination of the ALP is or has to be in accordance with the provisions of the Act and the rules thereunder. And if the ALP determination is not in accordance with the Act or the rules thereunder, it can be considered as perverse. What is meaning of perverse? Perverse meaning that it is contrary to the principles which are laid under the law. And if it is contrary to the principles laid under the law, that itself can give rise to the substantial question of law. The Supreme Court said that there is no absolute proposition that in all the cases, if the tribunal has determined the ALP, the same is final. So the ALP, whenever it is decided by the tribunal, it is always open for the High Court to consider and examine whether the ALP has been determined, taking into consideration the guidelines under the Act and the rules. The High Court can also examine the question of comparability of the companies or applying the filters to decide the comparability and whether the same has been done judicially or not. Therefore, the Supreme Court held that the determination of ALP can be determined by even the High Court, can be examined by the High Court. Are we clear? So you can write down over here. The determination of the ALP has to be in accordance with the provisions of Chapter 10, Section 92 to Section 92F and the rules thereunder. Right? If the ALP is not in accordance with the provisions of the Act and rules, it can be considered as perverse. Therefore, the perversity itself results in substantial question of law. Substantial question of law. The High Court can consider and determine. The High Court can consider and determine whether the ALP has been determined in accordance with the provisions under the Act. The High Court can also decide comparability. High Court can also decide the comparability or selection of filters and examine whether the same is done judicially. Same has been done judicially. Sorry. Judiciously and on the basis of relevant material on record. Okay. Material or evidence on record. The High Court can also examine whether the comparability, whether the comparable transactions have been taken into consideration properly or not. Or okay, yes or no. No, High Court cannot apply interest or penalty. It can direct Janvi to the AO to apply the interest and penalty. So when the High Court decides the order, it gives the directions to the AO in these cases. And the AO will pass the order giving effect to the High Court order. And then it will charge the interest or penalty. Okay. Yes, Janvi, in the cases where interest, as I said, is mandatory, but for the penalty, the bona fide clause can be taken that since the ALP is a subjective exercise, the penalty will not be leviable. Okay. Okay, so next decision we move on to. Next one is with regard to the penalties only. Next two decision we are going to deal with is with regard to the penalty. So first one is, can the penalty under 271C, penalty under 271C, what is the penalty under 271C for? Penalty under section 271C is for the non-remittance of the TDS, sorry, of the non-deduction of the TDS or failure to deduct the TDS. So under section 271C, there is a penalty for failure on the part of assessee to deduct the TDS. Now the question before the Supreme Court in US Technologies was, is 271C also applicable on non-payment of TDS? So penalty under section 271C is on the assessee who is failing to deduct the TDS. But the question before the Supreme Court was, can 271C also apply where there is failure to payment or failure to deposit the TDS also? So the Supreme Court clearly held that here the Act is very clear. The Act says that failure to deduct the TDS. Nowhere the words payment or remittance or deposit of TDS is mentioned. Under 2011A, where you have interest on late deposit as well as interest on late deduction as well as late deposit. There separately the Parliament has provided for the interest on late deduction as well as late deposit. But under 271C, the Parliament has not provided for the late payment. The Parliament has only provided for failure to deduct. For failure to deposit, 271C does not say anything. The words are not or the words are absent under 271C with regard to the failure to deposit the TDS. Wherever Parliament wanted to levy the consequences on late payment, it has done so. So if you see under 2011A, there is an interest on late payment as well as late deduction. So the absence of the words failure to deposit cannot be added in absence of the clear mandate by the legislature. So therefore, 271C will not be applicable. So answer is no, as words failure to deposit are absent in 271C. Fine. Last decision, what we have to do is with regard to the 276B, which is prosecution. 276B is prosecution for delay in depositing TDS to the government. Prosecution for delay in deposit of TDS. So 276B provides for the prosecution if the person fails to deposit the TDS to the government, and the prosecution is imprisonment for minimum 3 months to 7 years. Now, what was the question before the Supreme Court? Can the prosecution proceedings be launched for delay in depositing the TDS to the government where the period of delay was not substantial, the amount of TDS was not substantial, and the TDS has been deposited later on along with the interest? So can the prosecution proceedings be launched? So the Supreme Court noted that there is a CBDT circular. CBDT circular of 2019, wherein it has been provided that the prosecution shall be launched in case of failure to pay TDS only if the TDS or TCS exceed rupees 25 lakh. Prosecution if TDS or TCS exceed rupees 25 lakh and delay in deposit is greater than 60 days. If delay in deposit is for more than 60 days. Right? So only in that case, the prosecution can be launched. In this case, the period of default was not substantial, the amount of deposit was not substantial, amount of TDS was not substantial. So therefore, the prosecution will not be launched. Okay, so no prosecution if delay and deposit of TDS not substantial. Fine. So these are very small rulings which are there for the November 23, which all of which I have covered for your attempt. Are we clear? Okay. Yes. Are we clear? Yes or no? Now, few judicial updates that we have to cover, which I'll directly cover it from your statutory update part, which is given as a part of your module. Okay, are you able to see my screen? Yes. So this statutory update, which is given for the November 23 examination, which is what we are going to cover now. Now, one statutory update is with respect to the non-operative PAN becoming non-operative or inoperative. So if you remember, the PAN has to be linked with the Aadhaar. And if the PAN is not linked with the Aadhaar till 31st March 2022, then in that case, the PAN becomes inoperative. Now, from 1st July 23 onwards, there are consequences for the failure to intimate the Aadhaar and the PAN becoming non-operative. What are the consequences? The refund of the amount shall not be given. Interest will not be paid on any refund due during which the PAN has been inoperative. Where TDS is deductible, the TDS shall be deducted at the highest rates under 206AA, which is 20%. Similarly, TCS will also be collected at the highest rate under 206CC, and the fee of 1000 will continue to apply to make the PAN operative only when the Aadhaar is intimated. So from 1/7/23, these consequences will be applicable. Are we clear? Second is, the clarification has been issued in respect of the cooperative societies which are into the agriculture. So what happens is, in these cooperative societies, there was a concern whether 269 ST, which provides that no person can receive amount of rupees 2 lakh or more by account paid by other than account paid check or account paid draft from a person in a day, or in respect of a single transaction, or in respect of the one event or occasion from a person. Now, these cooperative societies which are there, they receive the amount usually from the distributors. Now, these distributors usually, what happens is that in case there are bank holidays, or in case there are certain off days which are there, in those cases, it is quite possible that they may receive the amount in cash. They may receive the amount in cash. So in that particular case, the concern was whether 269 ST will be considered, considering that an amount has been received from a single person. So what was the concern? So in respect of these milk producers cooperative society, receipts in cash on the bank holiday from the distributors against the sale of milk, whether it can be considered as a single transaction and therefore treated as one event or occasion. So the CBDT has clarified that, that in respect of the transactions which are received from these distributors or dealers, this may not constitute as one single transaction or one event or occasion, and this will not be aggregated for the purpose of 269 ST. Are we clear? Next is, with respect of interest income will now also be reported in the statement of financial transaction. So earlier there was a limit of 5,000 per person. Now that limit has been removed. So even 1 rupee of interest will be reported in statement of financial transaction, and therefore you can see these interest income as a part of your AIS, because the banks reported to the income tax department by way of SFT, and therefore it is now reflected in your AIS. Okay. So banks need to file the statement of financial transaction by reporting interest, and there is no limit for the interest. Okay, milk producer, as I said, Kaushiki, the cooperative society receives the cash from the distributors of the milk, usually on bank holiday. So whether these receipt from the distributor can be considered as single event, that was the clarity these cooperative societies wanted to require. And now it has been clarified that this will not be considered as a single event. Are we clear? Yes or no? Yes? Okay. So let's take a small break of 10 minutes, and then we get back with the question answers in relation to the PGBP. Okay. Till then, I'll give you the question. You can start writing this particular question, and there's this additional information which you can write later. But then, till then, you can start writing this particular question in the break if you want it. Okay. We'll meet after 10 minutes. Students, have you gone through this question? Let's quickly go through it. Light Limited, an Indian company engaged in the business of manufacturing of electrical products, has reported the net profit of 1.2 crore after debiting or crediting the following item. Engineering fees to the XINC for the installation of machinery without deducting the TDS. However, XINC has filed its ITR disclosing this income and paying the due taxes on the same before September 30, 2023. Contributed to Employees Welfare Trust rupees 2 lakh. Amount of 30,000 was paid to an employee in cash on his retirement. Company had ongoing loan with Bank of India and had requested to convert the interest due of rupees 10 lakh into new loan, which would be repayable in 5 installments. SSC has paid the 2 installments during the year. An employee, Mr. Raj, was deputed to Northeast for official tour for 20 days. Company paid the salary in cash of rupees 1 lakh as there was no bank account there. TDS has been deducted on salary under 192. Amount of rupees 3 lakh was incurred on installation of glow signboard. For the advertisement, you can write. The company has paid rupees 5 lakh as regularization fees to municipal corporation to regularize the deviation from sanctioned plan in construction of factory building. Depreciation based on useful life of assets rupees 300 lakh. Incurred rupees 8 lakh on travel expense of MD and his wife for business trip to UK on invitation by the Chamber of Commerce. Provision for gratuity based on actuarial valuation rupees 7 lakh. Actual gratuity paid rupees 1.5 lakh. Interest on GST late paid rupees 1 lakh. And additional information is given. Opening and closing stock for the year was 55 lakh and this was overvalued by 10%. The closing stock was 54 lakh and was undervalued by 10%. The machinery was acquired from UK for pound 2.5 lakh on 9 September. The rate of exchange was 90. Assessee paid the amount on 31st March when the exchange rate was 99. Trial run expenses was 2 lakh. Custom duty was 20% of purchase price. And the assessee financed the machinery through the loan of 10 lakh and the interest was 2.5 lakh. Details of other assets are given. Both employer and employee contribution of PF were deposited on 1st July for the month of March. Calculate the total income. Yes. So please start with it and one by one give me the answers for each and every adjustment. Yes. I'm giving you 5 minutes time to go through the question and give me one by one answers. I'm adding one more adjustment meantime. in the additional information so that you can have that plus as well. You can write the adjustment meantime. The company has employed. The company has employed the employees to which salary was debited to P&L account. Was debited to P&L account. Fine. So date of appointment, first column. Number of employees. Number of employees. Then salary per month. First is date of appointment, 1st July 22. 1st July 22. Number of employee 1. Salary per month 22,000. Mode of payment, another column you can make in cash. Next is again 1/7/22. 4 employees. 1/7/22. 4 employees. 11,000 by account pay check. 11,000 by account pay check. Then 1/8/22. 1 employee 25,000 by ECS. 1 employee ECS. Then 1/10/22. 1/10/22. You can write down 35 employee 30,000 again by ECS. And finally 15/10/22. 10 employees. The salary is 10,000 ECS. Fine. Yes, start solving now. Also, you can make one more column, type of employee. You can write regular, regular, casual, regular, and regular. Okay. Yes. Okay, let's start. Okay, Janvi, I'll try to upload the questions beforehand. Okay, let's start solving. Engineering fees to the XINC for the installation of machinery without deducting TDS. However, XINC has filed its ITR disclosing this income and paying the due taxes on the same before September 30, 2023. Yes. So first, disallowed, allowed, disallowed, allowed. What will happen? Yes. So which provision you are applying? Tell me the provision also where you are saying it will get disallowed or it will get allowed. Which provision? You have to give me the section number also. Which section number? Section number what? 40A1. 40A1. What does 40A1 say? That in the case of any assessee, any interest, royalties, fees for technical services, or any other sum chargeable under the Act. What does it say? So this is how we are going to revise it, right? Section 40A1. Right? What does it say? Interest, FTS, royalties, or any other sum chargeable to tax. Any other sum chargeable to tax under the Act if the payment is made outside India or in India to a non-resident or a foreign company on which tax is deductible, right? Paid outside India or to a non-resident on which TDS is deductible. TDS is deductible and TDS has not been deducted. Or after deduction, TDS has not been paid on or before the due date of 139(1), on which TDS is not deducted or deducted but not paid. On or before due date of 139(1). Then this will get disallowed. Then this will get disallowed under 40A1. The proviso to 40A1 says that in respect of that sum, tax has been deducted, let's say, in the subsequent year, or has been deducted but paid after the due date of 139(1). Then the amount will be allowed as deduction in the subsequent year when the tax is paid. If then again the second proviso to 40A1 says that where the assessee fails to deduct the tax or fails to pay the tax, right? If the assessee fails to deduct the tax, then the assessee will not be treated as assessee in default, because if the if the recipient has included that income and paid the tax on the same while furnishing the return of income, then the assessee will be allowed the deduction. the assessee will be deemed that he has deducted and paid the tax thereon. Are we clear? So in this case, since the foreign company has included this income and paid the taxes before the due date of its return of income, then that particular case, this sum will be allowed as deduction. So, allowed as deduction. Now, let's say, for example, if instead of September 30, foreign company would have paid the taxes, let's say in December 23. Then in that case, the deduction would have been disallowed and allowed in next AY, which is 24-25. Are we clear? So be very careful when you are answering the question. Okay? So 40A1. 40A1 proviso applicable. Are we clear? Contributed to the Employees Welfare Trust, rupees 2 lakhs. What will happen in this case? Contribution to the Employee Welfare Trust. What will you do? Yes. lakh contributed to the Employee Welfare Trust, whether it is allowed or whether it is disallowed, and which provision you will refer to. Janvi is saying allowed. Kaushiki, yes, allowed. Yes, Janvi, correct. So which provision I am referring to? Anyone? Which provision you are saying allowed or not? Keep your module in front of you. You will find all the answers. Yes. Which provision are we looking at? Past. Yes, students. Which provision? Past. See, you have to revise very quickly, okay? And that's the reason why I told you to come and revise this. Okay. Let me open up the module also for you so that, we look at side by side. See, contribution by employers to the funds or trust. 40A9. No deduction will be allowed where the assessee pays in capacity as an employer any sum towards setting up or formation of or as contribution to any fund, trust, company, AOP, BOI, society. Right? However, where such sum is paid in respect of the funds covered by 3614 4A or 3615, then the deduction will not be denied. So therefore, where the employer contribution is made to the fund or trust, then this will not be allowed as deduction under 40A9. If it's recognized pension fund, PF and all of that, then only you will get the deduction under 3614 4A or 3615. Are we clear? So under 40A9, you will not get any particular deduction. Is that clear? Right? So this is not allowed as deduction under section 40A9. Amount of rupees 30,000 was paid to an employee in cash on his retirement. What will happen in this case? Yes. Amount of cash of 30,000 paid to an employee on the retirement. Okay, before that, one more point I would like to say, for the contribution to the Employee Welfare Trust. There is one Supreme Court ruling as a part of your syllabus, which is in the case of Shasun Chemicals and Drugs. So in case where the payment of bonus due to the employees is paid to a trust, and then that amount is subsequently paid to the employees before the due date. If the amount is paid to the trust as a bonus, the trust is set up for the payment of bonus to the employee, and then that amount is paid subsequently to the employees before the stipulated due date. Then whether that amount will be allowable as deduction? The answer is yes. The amount will be allowable as deduction, because the bonus was ultimately paid to the employees before the due date under section 36(1)(2). So if the amount is paid to the trust, and that trust pays the bonus to the employees before the due date, then in that particular case, the amount will be allowed as the deduction under section 36(1)(2) as the bonus. So if the amount is paid before the due date of 139(1), because 43B will be applicable on the payment of bonus, and therefore the amount will be allowed as the deduction. So you can write it over here, make an asterisk and write it. If the amount is paid to a trust as employee contribution, disallowed under section 40(a)(9). Amount paid as employee contribution to PF or pension fund, that is allowed under which section? 36(1), 4A, right? That is allowed under section 36(1), 4A and 4 and 5. So contribution to the employee's recognized provident fund or superannuation fund or gratuity fund, then that is allowed under section 36(1)(4) and 36(1)(5, or superannuation fund or gratuity fund. So this is allowed. Bonus of employees paid to the trust, and trust pays to the employees before the due date, allowed. This is as per Shasun Drugs Limited. Shasun Drugs Limited. Okay. Are we clear? So this is how you will revise it. Are we getting it? So employer's contribution to the account of the employee is allowed under 36(1)(4)(a). Under 36(1)(4)(a), right? And 40(a)(9) which is there, and 36(1)(5) and 36(1)(4) is for the employee contribution. Are we clear? Are we clear? So even employer's contribution under any pension fund to any trust is also disallowed under 40A9. Any sum paid by an employer towards contribution to any fund or trust is disallowed under 40A9. However, what is excluded from here is 3615, 36148, 3614. Okay, are we clear? Any doubt? Any doubt? Can I give you one more small example on this so that you understand it correctly? Okay, so I'll give you the illustration from the module itself. If, let's say, for example, the adjustment would have been that Light Limited contributes 20% of basic salary. Contributes 20% of basic salary under statutory pension scheme under section 80 CCD. Right? Under section 80 CCD. The basic salary is 10 lakh. And DA is 40% of basic salary. Right? DA is 40% of the basic salary. DA is 40% of the basic salary. Okay. So now in this particular case, how will we compute the deduction? How will we compute the deduction? Yes, Kaushiki, trust is disallowed. Trust is disallowed, right? So any contribution to the trust is completely disallowed if the bonus is paid to the trust, and that trust is then paying the bonus to the employees, then it will get allowed because the amount is being paid before the due date of the return of income. Are we clear? Here the amount is being paid in check. It is not paid in cash. Nowhere it is written that it is paid in cash. Where it is written in cash, what we are discussing here is, we are discussing about this particular point. Contributed to the Employee Welfare Trust 2 lakh. Nowhere it is written that it is being paid in the cash. This is paid by the account payee check only. What is our whole point is whether it will get allowed. So 40A9 will disallow it. 40A9 will disallow it. Okay. But if the bonus had been paid to the trust and then the trust pays to the employees before the due date, then it is allowed as per Shasan Drugs case. Okay. Now the next question is, let's say for example, Light Limited contributes 20% of basic salary under the statutory pension scheme under 80 CCD. Basic salary is 10 lakh and DA is 40% of the basic salary. Now what will be my disallowance under 40A9? Whether there would be some disallowance. So let's say my basic salary is 10 lakh. My basic salary is 10 lakh, right? My DA is going to be 4 lakh. So 14 lakh is basically my expense, salary, right? Now under 36(4)(a), what is the contribution that I will be paying? So employer contribution under section 36(1)(4)(a) is 20%, right? So this is going to be what? 20% of basic salary, which is 2 lakh. 20% of basic, which is 2 lakh, right? Now, what is the permissible deduction under 36(1)(4)(a)? The permissible deduction is deduction under section 36(1)(4)(a) is 10% of basic plus DA, which will come to 1.4 lakh. So the excess 60K will get disallowed under 40A9. Disallowed under section 40A9. Are we getting this? So let's say, for example, I had given you the adjustment in this particular manner. If my adjustment would have been in this particular manner, then you would have solved the problem in this way. So let's say if my adjustment would have said, instead of that particular adjustment that I've just contributed to the trust, I would have written Life Limited contributes 20% of basic salary under the pension scheme. Basic salary is 10 lakh, DA is 40%, and what will be the allowability? So allowability will be only up to the extent of 1.4 lakh. The excess amount will get disallowed. Are we clear till now? Yes or no? Are we clear? Janvi, it is 10%. Under 80CCD, sorry, under the 3614, 10% is allowed. Are we clear? Any doubt? Yes, students, any doubt? This point is entirely clear. So in any form, the adjustment will come in examination. You would be able to answer it. Isn't it? You would be able to answer or not? Yes or no? Yes. So 3614, only 10% will get allowed. 3614A. Right? 10% of the basic plus DA. Over and above will get disallowed under 40A9. Clear? So 40A9 excludes what is allowed under 3614 to the extent of contribution to the pension scheme under 80CC. Yes? Can we move to the next point? Okay. So the adjustment can come in any form. So even though I've written one adjustment, I'm solving with you multiple alternatives or permutations to that adjustment so that once it comes in examination, you are able to answer any problem. Once you understand the fundamental, register it and you will be able to solve anything. Okay. So contribution to the trust for the employee-employer contribution and any employer welfare trust disallowed under 40A9. Except to the extent of employer contribution, which is allowed under 3614, which is 10% of salary. Employee contribution is again allowed under 3614 and 3615. If the bonus is paid to the trust and trust pays before the due date of ROI, then that is allowed Shasan drugs case. Okay. Amount of 30,000 paid to an employee in cash on his retirement. Yes. Yes, tell me. Yes. Yes, students. Allowed, disallowed, disallowed. Okay, Janvi. Okay, Kaushiki. No, that's not the correct answer. It is allowed. Can anyone give me the reason why it is allowed? I've given you the answer. I've already given you the answer. Can you tell me why it is allowed? Yes, Kaushiki. Very good. So, you have section 40A3. You have section 40A3. This is allowed. And why it is allowed? Because under section 40A3, under section 40A3, the cash payments greater than 10K are disallowed. But there is the exception. There are the exceptions, and where are these exceptions given? Under Rule 6DD. The exceptions under Rule 6DD. What are those exceptions? There are many exceptions which are given under Rule 6DD. And one of the exception there is where any payment is made to an employee or any legal heir of employee in connection with the retirement, resignation, retrenchment, gratuity, and the payment does not exceed 50,000. And the payment does not exceed 50,000, then in that particular case, it falls under the exception of Rule 6DD. And that will be allowed. So what is the exception? Payment to the employee in connection with the retirement and payment less than 50,000. Then in that case, it will fall under exception to Rule 6DD. Are we clear? What are the other exceptions to Rule 6DD? There are many exceptions. Payment is made to the banks. Payment is made to the government. Payment is made by any bill of exchange, telegraphic transfer, where the payment is made by way of adjustment against the amount of any liability incurred by the assessee for any goods or services. So if an account adjustment has been made, payment made for the purchase of agricultural or fish products, payment is made for the purchase of the cottage industry manufactured products, payment is made in a village or town which is not served by the bank, right? Where the payment is made to an assessee by way of salary to an employee, where TDS has been deducted, but that employee is posted for more than 15 days other than his normal place of duty or on a ship and does not maintain any account in any bank. Payment made to an agent who is required to make payment in cash. Payment made to the authorized dealer for purchase of foreign currency. All of these fall under the exception under Rule 6DD. Okay? Fine. So this is allowed. Okay, next one. Okay, one more point before we move further towards the first point. I'm just thinking, whenever these points are coming up, I'm again going back. So in the first point, we saw engineering fees to ex-INC for installation of machinery without deducting the TDS. Now, in this case, we know that it has filed the ITR, it has offered the income and paid the tax. But let's say it has not done that. The recipient has not done that. And let's say instead of engineering fees, let's say payment is being made to ex-INC for, let's say, an income which is not chargeable to tax in India. Let's say income which is not chargeable to tax in India. Let's say commission to an agent for the purpose of promoting the business outside India, for the marketing commission paid to an agent, non-resident agent, for the purpose of marketing the products outside India. Now, in that case, the commission to a non-resident agent is generally not taxable. Generally not taxable because that is being paid for the purpose of business outside India. Right? So therefore, in that case, whether the TDS is not deducted, whether the disallowance under 40A1 will be made. Let's assume recipient has not paid any taxes. Yes, Kaushiki, allowed as not taxable in India. Because for 40A1 to be applicable, what did I say? The sum should have been chargeable to tax in India. So if a commission is paid to a non-resident agent, which is not chargeable to tax, then no disallowance. No disallowance. Okay? No disallowance under section 40A1. Fine? Okay? Let's move on to the next one. The company had the ongoing loan with the Bank of India and had requested to convert the interest due of rupees 10 lakhs into the new loan, which would be repayable in 5 installments. The assessee has paid 2 installments during the year. Yes. Yes, Kaushiki, correct. Yes. Yes, Janvi, correct. Okay. So section 43B. Section 43B is getting attracted over here. So what does 43B says? 43B says that interest to any financial institution or bank allowed as deduction on payment basis. On the payment basis. Right? Now, explanation has been introduced to clarify that if any loan is payable and any interest is payable on that loan, and if that interest is converted into a loan, if any accrued interest is converted into a loan, the interest, when it gets converted, will not be deemed to be paid, will not be deemed to be actually paid, and hence would not be allowed as deduction. So the unpaid interest, if it is converted into loan, that would not be considered as actually paid. The unpaid interest, whenever actually paid to the bank, will be allowed as the deduction. So whenever the converted interest installment is paid, only then the deduction will be allowed. So converted interest, explanation to section 43B provides that converted interest to loan not actually paid, deduction allowed on actual payment of converted loan. Okay. So in this case, the deduction will be allowed of the 2 installments. Deduction of 2 installments. Okay. So 10 into 2 divided by 5, which is of 4 lakh. Okay. An employee, Mr. Raj, was deputed to Northeast for official tour for 20 days. The company had paid salary in cash of rupees 1 lakh. As there was no bank account there, TDS has been deducted on salary under section 192. Yes. Yes, Sri Ram, you were correct. January 6 DD. You have to write fully in exam, okay? Yes, Kaushiki, correct. Yes. Kaushiki, yes. In point 4, 3 installment disallowed. Yes, because you have only paid the 2 installments. Even though you have debited the 5 installments in P&L, so only 2 will be allowed because you have paid only 2, correct? You have not paid the 5 installments. So when you pay next 3, you will be allowed. Yes, all 5 are debited in P&L because the interest was accrued. Okay? Okay, so in this case, this is covered by Rule 6DD. We just now discussed. So this is allowed as covered by Rule 6DD. So if the employee is posted for more than 15 days and TDS is deducted and he does not maintain any bank account there. If TDS would have not been deducted, then it would not have fall within the Rule 6DD exception. So it is mandatory that the TDS should have been deducted. Then it would have directly got disallowed under 40A 1A. How much disallowed? 30%. If TDS is not deducted on salary, if TDS not deducted, then 30% disallowed under section 40A 1A. For non-resident payment, 100% disallowance is there under 40A1. For resident payment, 30% disallowance under 40A1A. Are we clear? Yes or no? Are you enjoying this way of revision? Yes? This is how you should be revising, right? Are you enjoying it? Getting to revise properly, getting to solve these questions with all the different alternatives of adjustments. Okay? Fine. Amount of rupees 3 lakh was incurred on installation of glow sign board for advertisement. Yes. Great, Kaushiki. Yes. So, but this way, I'm also covering the different case laws as well for you. Not only the provisions, but the case laws also are getting covered. So be mindful. Yes. Yes, fast. No, Shriram. Yes. Kaushiki, correct. No, Janvi. Okay, let me tell you. So this is a judgment which is there. This glow sign board is a Delhi High Court ruling and not Supreme Court ruling, Kaushiki. So what does it say? There's this Delhi High Court ruling in Orient Ceramics and Industry Limited. So for the glow sign board, Delhi High Court ruling in Orient Ceramics. So the expenditure on glow sign board is revenue in nature because this does not bring any new asset into existence or any advantage for the enduring benefit of the business. So when the expenditure would be capital in nature, when there is a new asset coming into existence or there is any advantage for the enduring benefit. Now you may say, ma'am, glow sign board may give a benefit for longer time, but it is not an asset of permanent nature. It is having a very short life, right? It has a very short life. Tomorrow the monsoon will start, rains will come, it may just get wiped off. So the materials used in the glow sign board decay with the weather, decay with the monsoon, right? And therefore it requires the replacement and repair. And the assessee has to incur the expenditure regularly. So therefore, this is not an advantage of the enduring nature. And therefore, it will be revenue expenditure. So you can write down the expense on glow sign board would be a revenue expense as no new asset coming into existence and no advantage of enduring nature. Are we clear? Okay, fine. Next one. Company has paid rupees 5 lakh as regularization fees to the municipal corporation to regularize the deviation from sanctioned plan in construction of factory building. This is allowed as revenue. Okay, first one we'll write it. The company has paid 5 lakh as regularization fees. What will be the answer? Yes, Kaushik, you are correct. Sriram, you can write the provision even if you don't remember the section number. Yes, Kaushiki, correct. So again, this is as per the ruling of the Karnataka High Court. Amount paid for the regularization fee, whether it is allowable as the deduction. Kaushiki, if you can, good. If you cannot, then also it's fine. The judgment name. No, Janvi, this is not a capital expenditure. Okay. So the regularization fee which is paid, right? This is paid to regularize any offense which has been committed by the company. Why this regularization fee is paid? This is like a compounding fee. Compounding fee means what? That I am regularizing the offense so that I do not have to bear any other consequences. I'm paying off the fees so that I do not have to bear the legal consequences. So since the company has deviated from the sanction plan, it had paid this fees in order to compound its offense. So any regularization fee paid to compound an offense is obviously a penalty. And as we had discussed in the last class, any penalty which is being paid is not allowed as deduction under section 37. Right? So compounding or regularization fees paid not allowed as deduction under section 37 as it is in nature of penalty. Depreciation based on useful life of asset rupees 300 lakhs. This is very simple. Janvi, the license fee or renewal of license fee is the revenue expenditure. Kaushiki, disallow, yes, correct. So this will get disallowed because the depreciation will be allowed as per the Income Tax Act. Okay. Incurred rupees 8 lakh on travel expense of MD and his wife for business trip to UK on invitation by Chamber of Commerce. Yes. Yes. Allowed. Kaushiki is saying allowed. Yes, as it is a business practice to take wife along with. Yes, correct. So this will be allowed as expense because this is a business practice to take their spouses along with. So this is something which is a necessity and therefore it is allowed as, yes, correct, Janvi. This will be allowed as the expenditure. So this is allowed as it is business practice. Provision for gratuity based on actuarial valuation of rupees 7 lakh, actual gratuity paid rupees 1.5 lakh. Yes. Yes, only 1.5 lakh is allowed. Janvi, correct? 5.5 is disallowed. Which provision again we are referring to for gratuity? 40A7. Section 40A7. Only the actual gratuity paid is allowed. Provision for gratuity is not allowed. Actual gratuity allowed. Fine. Interest on GST late paid. Interest on GST late paid. Interest on GST late paid, rupees 1 lakh. Yes, Sriram, you were correct. Yes, Kaushiki, this is not a penalty. This is interest on GST late paid. It's a contractual amount, contractual interest, and therefore allowed. Interest on TDS or income tax. Interest on TDS or income tax. Kaushiki, only when the gratuity amount is paid, only then it is allowed. Yes, Janvi, interest on GST allowed, correct. Interest on income tax, whether allowed or not. Yes, correct, Janvi. Interest on income tax or TDS is not allowed. Fine. Few more adjustments I'm writing for you just to make it more comprehensive. Adjustment number 12, you can write down the interest accrued was rupees 2 lakh on loan taken from ICICI. TDS not deducted with the contention that actual interest is not paid but is payable. Therefore, TDS, therefore disallowance. Okay, just write down this. Actual interest is not paid but is payable. Yes, allowed, disallowed. Expenditure of rupees 5 lakh incurred on issue of collection of CCD, compulsory convertible debentures, and rupees 2 lakh on issue of bonus shares. Tell me the answers for both. Interest disallowed? Yes, Janvi, correct. Kaushiki, no. Okay. So interest accrued was rupees 2 lakh on loan. TDS was not deducted. So therefore, 30% disallowed under section 40A1A. 40A1A. Okay. But okay, let me see here. 43B will also get attracted if I write interest, because otherwise, what will happen? Entire amount gets disallowed under 43B. Let me change it from interest to the contractor fee. Contractor fees was rupees 2 lakh. TDS was not deducted as on the contention that the fees is not paid but payable. Because if I have put here interest any which will get disallowed because the payment has not been made under 43B. You are correct, Kaushiki. So if the contractor fees is 2 lakh and if the TDS is not deducted on the same, 30% will get disallowed under section 40A1A. One cannot take the contention that 40A1A will get attracted only if the amount is paid. That contention cannot be taken. So 40A1A gets attracted even if the amount is payable. 41A gets attracted even if the amount is payable. Even if amount is payable. Supreme Court in Palam Gas. Okay, Supreme Court in Palam Gas. Expenditure of 5 lakh incurred on issue and collection of CCD and 2 lakh on issue of the bonus shares. What will be the answer? Yes. What will be the answer? Fast. Fast, fast. Issue of bonus shares. Yes. Whether issue of bonus shares is a capital expenditure or revenue expenditure. The expenditure on issue of bonus shares. What will be your answer? May 23 at least. Those who have set for the May 23 would know that. Okay. So issue of the compulsory convertible debenture, it should be of capital nature, so not allowed. Okay, Janvi is saying has no effect on capital. Issue of shares, okay, it will be disallowed. Yes, Janvi, correct. So first is with respect to the issue of the compulsory convertible debentures. Now, as far as the compulsory convertible debentures are concerned, with respect to that, whether it's a capital expenditure, the answer is no. It's not a capital expenditure. So debentures, when can we say when it's a capital expenditure? When there is an effect on the capital field. When there is an effect on the capital field, right? Here, if you see, there is no effect on the capital field because these are debentures at the end. There is no impact on the capital field. So therefore, in that particular case, in case of the debentures, even though they are convertible debentures, there will not be any impact. There will not be any impact, and therefore that will be treated as the revenue expenditure. Similarly, in the case of the bonus shares, what happened? I am just changing the amount from the reserves to the capital. So what is happening is, from one pocket, I'm putting the amount through the another pocket. So bonus shares are issued out of your reserves only, right? So there is no impact again on the capital field. It is the changing from the reserves to the share capital. And therefore, any expenditure which is incurred in connection with the bonus issue, it does not change the capital structure. And therefore, if that expenditure will also be allowed as the deduction. So you can write down expenditure on the issue and collection of the convertible debenture revenue as not in capital field. ITC limited case. Okay. Similarly, this is also revenue as no change in capital structure. Fine. As no change in the capital structure. For this also, you can again write down the ruling of General Insurance Corporation. General Insurance Corporation. Fine. Last one adjustment should I give with respect to the bad debts. With respect to the bad debts, write one adjustment. Write the adjustment. Amount debited to the provision for doubtful debts. One second, just take it. Okay, last adjustment. Provision for doubtful debt rupees 10 lakh. Provision for the doubtful debt rupees 10 lakh. The bad debts disallowed. Sorry, bad debts allowed as actual bad debts. Actual bad debts rupees 2 lakh. And the actual bad debts rupees 2 lakh. Yes. What will happen? What will be your deduction? Yes. Correct. Yes, Janvi. Yes, Kaushiki. Correct. So 8 lakh will be added to the income and balance will be allowed as deduction. So 2 lakh is allowed under section 36. Under section 36, 2 lakh will be allowed as deduction and the balance will get disallowed as deduction. So under 36(2), the deduction will be provided. Fine. And provision for doubtful debt will be disallowed. This is disallowed. And this is allowed under 36(2). Fine. Now additional information, opening and closing stock. Okay, let's do one thing. I think we'll not be able to finish the sum. What I want you to do is, you will solve this additional information. Now see, the main portion we have already covered. We have 1, 2, 3, 4, 5 adjustments under the additional information. One is of the opening and closing stock. Then it is in respect of the machinery and depreciation. So you'll calculate the depreciation for me in the next class. And the employees. Okay, there are 6 adjustments. So the employee's salary has been debited to P&L. So that is also there. This is with respect to the 80JJAA. Right? So I want you to solve this additional information because otherwise it will take a lot of more time. And we are on the end of the class. Also, one more thing, I want you to revise for the next class, which is going to be the specified deductions. What you're going to revise 33AB, 35AD, then you are going to revise the 80IA, 80IB and 10AA, the scientific research. All of this you are going to revise before your next class because we are going to solve some around that. So in the next class, what we are going to cover is 35 AD, section 35, 33 AB, tea plantation, coffee plantation, rubber development. Section 35, 80IA, 80IB, those sections. 10AA, which is for the export oriented. And finally, the partnership taxability. So all of this you are going to revise in the next class. Are we clear? Right? So will you revise before the next class? And you will solve this particular portion because it's going to take another half an hour and we are already at 9. So what we can do is we can continue in this particular portion in the next class. We've already covered the main portion. Okay. So depreciation and at least this you can solve it. Fine. Okay. Any questions before we close the session? Yes. Yes, Janvi, for inventory, you will calculate from the 55 lakh, it is overvalued and closing stock, it is undervalued by 10%. So the 10% needs to be calculated around that. Are we getting that? Yes. So the closing stock has been undervalued and the opening stock has been overvalued. So since the opening stock is reduced, you will add back the opening stock overvaluation, right? Because it is overvalued by 10%. So this is the overvalued figure. And the undervaluation of closing stock. So closing stock is basically added. So this is undervalued, so you'll add more, the 10%. So this is reduced by 10. So this is going to be into 10 divided by 90. So overvaluation of opening stock 55 lakh into 10 divided by 110. Undervaluation 54 lakh into 10 divided by 90. Fine. Any other question? Okay. So thank you so much. We'll meet in the next class, which is directly, I think, on now Monday. Monday we'll meet up and by then we will have a few more problem solving around the PGBP only. But as I told you, like you have to revise those particular topics. Okay. Thank you so much. See you in the next class.